Understanding employment and your income and how it works with your mortgage loan. That's what we'll be talking about today. This is Erica Naglin with loansbyerica.com. So I want to just kind of discuss with you the importance of your employment verification when it comes to qualifying for a mortgage loan and all the documentation that we ask for, such as pay stubs and your tax returns and your W-2s. So it's really important that on your pay stubs, we're able to verify that you're working 40 hours a week if we're qualifying you based on 40 hours a week. So if for some reason you don't get paid holidays or time off, then it could affect your ability to get qualified if we use the 40-hour work week. So it's really important to communicate that with your loan officer and myself so that I can go ahead and make sure that I've calculated things properly. The other thing that we're looking for is continuance of income. For example, we're looking for things like if you want us to use the overtime to qualify you for your home loan, we want to make sure that that overtime is going to continue. And of course, we'll always take a 2-year average. The way that we verify continuance is by doing a verification of employment, also known as a VOE in my industry, with your employer. So what we'll do is we'll get in touch with the Human Resources Department. We'll verify that you do in fact work there, of course. The income matches what your pay stubs say. And then of course we'll verify things like overtime, bonuses, and are they going to continue? If they say they're not going to continue or they can't guarantee it, we could have a very big potential problem when it comes to using that income to qualify. So it's really important for us to know that in advance. If you have any idea that your employer is going to state that the overtime income is not going to continue, then you definitely need to let us know as soon as you possibly can, because we need to either rework the numbers or see if there's a problem or see if we can proceed on. The other thing that we're looking at when we're looking at your tax returns are for things called unreimbursed business expenses, otherwise known as 2106 expenses. If you look at your tax returns and you file a 1040A, you will not be reporting any 2106 expenses because there's no place for you to do it on that tax return. However, if you file a 1040, which is your long form of your tax returns, then you can itemize your expenses. That means you can itemize things like mortgage interest, you can deduct property taxes and things like that. If you keep going down that same form, you'll notice that there's a spot called unreimbursed business expenses. We have to deduct those from your income. So it's very important that if you have unreimbursed business expenses on your tax returns for the last 2 years, we will have to take an average of that and deduct it from your qualifying income. That can throw a lot of people out of qualifying for a home loan. So be sure and check on that when we're talking about your pre-qualification, because generally I don't have your tax returns in advance, so I don't know that unless you tell me. If you do happen to have that information, definitely have it handy when we talk so we can make sure that information is disclosed. The other things that we're looking for on tax returns is business ownership. If you own 25% or more of a business, then we need the business tax returns. In addition, we'll need the K-1s. Now, the K-1 document, if it's a sole proprietorship, if it's an S Corp or a C Corp, is going to tell me how much you own of that company. So once again, that document clearly tells me you own more than 25%, then I know right away I'm going to need those business returns. If you're a sole proprietor, then that's just going to be on your regular tax return under what's called the Schedule C. And that's where I'm going to be able to see that income on there clearly, or loss. And if it's a loss, of course, we have to take a 2-year average. If you pay yourself and you're self-employed and you pay yourself a pay stub like the rest of your employees, then certainly we need to have a copy of that, but we'll also see that clearly indicated on your tax return. The other thing, of course, is if your income is derived by Social Security, pensions, things like that, then we need to have proof of their continuance as well. So if it's a lifetime pension, you need to be sure and have something from your pension administrator that basically tells us that you do receive that information and that income for life. Same thing with your Social Security income. If it's retirement, then we can clearly see you're over the age of 65. If it's for disability, we need to have a letter from your doctor that states that your situation or your condition is going to continue for at least 3 years. I hope that this sheds a little bit of light on the information that we need when qualifying people on their income for a home loan. Again, this is Erica Naglin, loansbyerica.com.